UK inflation was not as bad as feared in November, falling short of expectations once again, but also, importantly, the Bank of England forecasts, which encourage traders to pare back their expectations for interest rate next year. In other words, markets are now pricing in more interest rate cuts from the Bank of England in 2024. Prior to this release, they were pricing in around 4 interest rate cuts. Now it's somewhere between 5 and 6, with that sixth viewed as a coin toss in December next year. Now, that's a lot, bearing in mind when you consider the Bank of England just last week voted 6-3 in favour of holding, with the 3 dissenters voting for another interest rate hike. So that would be quite the U-turn from the Bank of England to go from that position to cutting interest rates by 150 basis points next year. But when you see inflation falling as fast as it has been, and you see the fact that the numbers continually fall short of Bank of England and market-based expectations in a similar manner that we've seen in the US and the Euro area, then it's easy to understand why markets are getting ahead of the Bank of England. And when we see those new forecasts in February, when the Bank of England meets, I'm sure we will start to see a reflection of interest rate cuts coming next year. But we didn't have that in December, and that's probably why the Bank of England did continue to push back. Now, what does that mean ultimately for the charts? Well, as you can see here, the pound has been drifting lower against the US dollar over the course of today, on the basis of the fact that with more interest rate cuts being priced in for the Bank of England, that dovishness means a weaker pound sterling. In the same way that the pair had been drifting higher since October, because markets have priced in more interest rate cuts from the Federal Reserve compared with the Bank of England, whereas now in both cases we're looking at 150 basis points if the markets are to be believed. Now, the interesting levels here were the 61.8 fib, and we broke above there last week following those 2 central bank meetings. That was the point at which we could have got some information about whether we're talking about a retracement here or a return to a bullish phase in the pound dollar pair. And we did move above here, but we did hold around 128. And the reason why I had that marked on the chart is because historically 128, 130, 132 have been really interesting points of support and resistance. You can actually see back in the summer, we had a head and shoulders formation, which I'll mark on the chart now. The neckline was a little bit lower than there, around 126, but the shoulder peaks were around that 128 zone. So this stood out for me as being a potentially important area of resistance again, even though it falls just above the 61.8 fib. And we did see it run into resistance there and pull lower. We've now fallen short of there on a shorter time frame, and therefore failed to make a new high when we were already seeing momentum. You could see the momentum indicator at the bottom. This is the stochastic. We can see 2 lower peaks here when price was making a higher peak. You can see the MACD. The histogram was making lower peaks, and the moving averages were making lower peaks. That divergence around 128 stood out as a potentially significant area for me. And then we've seen it rotate lower, shy of 128 on this occasion. So we could be potentially seeing bearish indicators lining up on the pound dollar chart. So I think that's something I'm going to be keeping a close eye on now over the course of the coming weeks and months, especially if we continue to see data that will encourage the Bank of England to adopt a more dovish tone, as we saw from the Federal Reserve last week.